Hi, everybody. Welcome to the Q4 2021 PFA investment update, coming to you from 25th of January. As usual, joined by James Bradley.
Hi, Sam.
How are you doing, Jim?
I'm doing great. Happy 2022.
Yeah, same to you. All right, keeping things fresh, moving forward for you. Economic review, market review, looking forward, jumping right in with the economic review. Biggest indicator of economic performance is GDP, showing how we fell below trend line there. Real nice V-shaped recovery. This is as of Q3, Q4 GDP coming out next week. Should be getting even closer to that trend line. Just nice to note how long it took us to get back to that trend line after the 08-09 financial crisis versus this recession, which was more self-imposed and therefore easier to unimpose. There's a price to be paid. A lot of this recovery had to do with stimulus coming from both the Federal Reserve and the fiscal side. And that price is, I'm sure everybody is aware, is inflation right now. So the PCE price index up 5.73% annually as of November. December metrics coming out pretty soon and shouldn't be much change from that value. So, that's an average of a basket of goods that everybody's buying. It's not consistent across every good. Some of the big ones are energy costs and used vehicles, that type of stuff that's really pushed things through the roof. So you might see something like core PCE reported elsewhere, which excludes some of those more volatile things like food and energy. But that's where we're at on the inflation front.
We know the Fed looks at that PCE index quite carefully. And from where we are right now on the 25th, we're just before the Fed meeting. So we might, everything that we say today might be old by the time it actually gets out there.
Yep, always a risk. So everybody's noticed the prices going up at the grocery stores and everywhere, and feeling a little more strain on our pockets. But good news is more people are still having income than they otherwise would have if we didn't have things like stimulus from the Federal Reserve. Unemployment rate coming down from that high around 15-16%, now back to fairly normal levels at 3.9%. A couple caveats of that: participation rate is down lower than it was pre-pandemic. A lot of people are retiring earlier who are getting near the end of their careers anyway, and just saw this as a opportunity to get out of the workforce and not rejoin at the end. So not a huge, it looks like about a 2% down there, which isn't, it doesn't seem like a huge amount, but that's 2% of a population of 350 million people or something like that. So
it's a lot of people.
It's a decent amount of people that are not rejoining the workforce. And then down on the bottom, you can see the quits. 4.52 million quits in the most recent report, up near record highs. A lot of people reassessing what it means to work. Some of the jobs that they were working before, now they've been at home spending more time with family and stuff like that, and holding out for maybe something better that they're looking forward to. Not great for the economy, but not necessarily a bad thing for people's mental health and well-being.
Right. You hear the term the great resignation, and this is the graphical indication of that, isn't it?
Yeah. For the first time in a while, the supplier of laborers have the upper hand on people who need to use labor. So they are exercising that power, and you see that in the form of rising wages to incentivize people to come back to work. So it's an interesting dynamic going on.
Great. Yeah, looking at where we are now from the standpoint of January 25th, we're on the verge of hopefully the peak in the next round of the coronavirus, the next variant of the coronavirus, and that's the Omicron variant, obviously, or the Omicron variant, as I hear it referred to a lot. Interestingly, here, this is just kind of an index of the lockdown conditions that we see with each successive wave, and certainly picking up a trend there, aren't we? The first wave, lots of lockdowns. Second wave, not quite as many. Third wave, not quite as many. And Omicron here, again, every single iteration of this seems to lock down the economy less and less as, God willing, more of the population gets vaccinated, more of the population also actually gets infected and has some immunity that way, and more, the therapeutics are available to keep people out of hospitals and diminish the need to close things down regularly. This is becoming quickly, I'm thinking, an endemic type of thing that we're going to live with instead of a pandemic that we're going to have to close down for, which is good to look forward to. This normalization is further seen in a graph like this, where we see how, things like, credit card transactions and that type of thing dropped a little bit really early on, but then they actually picked up to above pre-pandemic trends. But gosh, look at the dive that things like seated diners and TSA traveler traffic went through. And those are, got close to being back to normal. Omicron pushed them back a little bit, but all good reasons to assume that those things like, indoor dining and people going on trips, travel trips, are going to get closer to normal. Actually, recreational travel, I just heard this morning, is really above trend as to where it was before the pandemic. It's business travel that's got a ways to come back.
Interesting. Yeah. Things still trending in the right direction after those huge drawdowns. I heard an interesting thought experiment lately, which was, imagine if this pandemic had hit 15, 20 years ago and Amazon was still a bookstore
Right.
and Zoom didn't exist and that type of stuff. So, from that perspective, a little bit of a silver lining that those tools that we needed came into existence just when we needed them most, and has allowed us to bounce back.
Thank
faster.
goodness for Zoom.
Yeah.
And darn you, Zoom.
Best worst thing that ever happened. All right, wraps up economics. Moving over to the markets. Jim's going to talk a little bit about asset class performance, starting with commodities.
Sure. Yeah, we always lead off with stocks. Why not mess it up and lead off with commodities this time? Interesting. You see oil. Everybody kind of sees this. When we're looking at inflation numbers at the gas pump, and that's the kind of second derivative of this oil spike. And oil is an asset that you expect to increase in value, at least in our current energy consumption and usage dynamic. When we're seeing an economic recovery, and lo and behold, that's the case. And something more defensive like gold, which tends to be kind of a run to safety type of asset during that kind of a period, isn't going to shine quite as much. So not surprisingly, a little bit of disparity when it comes to commodities, but overall commodities have been a good place to be in 2021. Stocks as well have, by and large, as we finished 2021, looking back, looking at the fourth quarter, looking at the 2021 as a whole, and gosh, looking back even at the last 3 years, have been a good place to put your money. Looking at the fourth quarter, the one place that's been a little bit challenging has been small cap growth stocks, and that's been the case actually for the whole of 2021, whereas large cap blend seems to have been the category to be in. So if following this logic, Sam, why don't we put all our money in large cap blend stocks?
Because that would be considered chasing returns, and technically is typically not a great way to make more money. And actually, this next chart, great segue, is going to show about the different asset class performances over time. It's called the quilt chart, best performing asset class for each year on the top versus the worst on the bottom. Here we see REITs were the best performing asset class in 2021, in part because they're becoming a great inflation hedge, but also look at the year they had last year. They were down pretty big, and you can see a bit of a pattern here. And things that are near the top tend to go down, and vice versa. They flip around a bit. So just a good selling point for diversification here of not chasing returns into the thing that was the most profitable last year, because it's unlikely to be the most profitable again. A little bit of a shift here, talking about equity valuations. Big year in the S&P last year, 26.9% up. Not purely speculation. This is showing earnings growth actually up 34.5%. So totally supported by earnings growth. Companies were, there were some concerns they wouldn't be able to protect their margins amongst rising input prices and rising labor prices and that type of stuff. But they did a very good job protecting their margins and grew earnings 34.5% on average. And the S&P actually underperformed that earnings growth because multiples got smaller, meaning the amount investors are willing to pay for dollars of earnings actually went down by 7.6%. So even though stocks had a big year up, they actually became cheaper.
It's encouraging, I guess.
Looking forward, a couple of points of volatility here. Quick reminder that volatility can manifest in either direction. So don't always let your mind go to the bad place. For example, inflation, if it goes up more than expected in the next year, that's going to be bad for markets. However, if inflation doesn't come in as hot as people are expecting it to be, that'll be very good for markets. And as kind of a derivative of that, interest rates, if inflation is higher than we expect, interest rates are going to have to be risen faster versus if inflation isn't as hot, interest rates won't have to rise as fast, and that'll be good for stocks. So these could come out either way. Federal Reserve meeting coming up here in a few minutes, looking at potentially 3 to 4 interest rate hikes this year. Markets really been pricing that in so far this year. I heard an interesting stat recently, though, that was the more markets price in interest rate hikes, the less they're actually probability to happen, because financial conditions worsen as the stock market goes down, and then the Fed wants to protect that by not raising interest rates at a time where the market's all volatile. So bit of an interesting correlation there. Also put valuations on here. Little bit of caveat on that, and that valuations themselves are not a catalyst for markets going down very fast or up very fast. They're kind of misunderstood in that way. It's more that high valuations mean a shock that's not priced into the market is more likely to create a lot of volatility. So high valuations themselves are not necessarily a bad thing. It just means if an unforeseen risk comes into play, market stands to lose more.
You're much more likely to suffer a fall injury when you're on the rim of the Grand Canyon than you are when you're down in the Colorado River.
Nice analogy. Geopolitics, a lot of people talking about Ukraine and Russia recently. Also China is another one to keep an eye on. Remains to be seen if this actually becomes a big risk to the market. A lot of talk about it right now. Russia in a lot of ways has kind of been boxed out of the global economy based on their behavior over the long term, but one place that they still do have a lot of influences in the energy markets, particularly oil. US has reduced their exposure to Russian oil quite a bit, but Europe still is pretty exposed. So that's an area to keep an eye on. And then with China, a little bit of a continuing spat going on from pre-pandemic. A lot of people talking about reshoring some of our manufacturing and stuff that is over there, especially in kind of critical supply chains. And then some human rights issues over there as well, to put it lightly, I suppose. So those are some sources of volatility. Talk about some sources of stability. Consumers and corporations remain very strong, and there's a lot of cash on the sidelines is the underlying factors here. Consumer credit scores actually went up during this last pandemic, which is very strange. That never really happens. People paid down a lot of debt, so debt payments are lower, more free cash flow. Likewise, both with the consumer and with corporations, banks especially on very good footing. So much less of like a systemic issue like we had back in 2008 at a time like this, where those balance sheets are looking strong, and there's $5.5 trillion of cash still on the sidelines, a lot of that coming from the stimulus that is yet to make its way into the financial markets. So that's a lot of dip buying that could happen to support markets. I'm going to kick it over to Jim now. He is going to take you to school on some stats.
Stats, yeah. Every once in a while we throw in some kind of a measurement or a ratio or a statistical measure that we just kind of brush past. And I was going to bring one up here, and I want to make sure I actually, for those who didn't go to Stats 101, or for those like me who did long enough ago to have forgotten everything from Stats 101, we'll talk about R squared. R squared is called the coefficient of determination. Sounds really kind of ominous and very quant geeky, but at the end of the day, it's a friendly measure. It's something that measures from 0 to 1, where 0 meaning two different pieces of information, two different series of data have no correlation to one another, and 1 means that two series of correlation have two series of data have perfect correlation with one another. So to take a really kind of simplistic example, let's look at the number of snowstorms that we have during this 2021-2022 season. I would suspect that if we have more snowstorms, we will see that stores will sell more snow shovels. You can almost bank on that being a relatively highly correlated in relationship. So that correlation will probably be that R squared will probably be a lot closer to 1 than to 0. Even in an inverse relationship, though, if it's perfectly inverse, then we're still going to see that R squared at 1. So like temperatures in the sales of mittens, the higher the temperature, the lower the sales of mittens, and the lower the temperature, the higher the sales of mittens. So regardless of whether it's a direct relationship or an inverse relationship, that R squared can be a pretty helpful number for us to look at in determining whether there's a statistical significant relationship between two series of data. And so this next slide gives us a chance to actually use that. And there's this measurement. Maybe we'll use this one as a lesson for next quarter when we go through it, called Shiller price to earnings ratio, or Shiller's PE, or Shiller's cyclically adjusted price to earnings ratio, whatever you want to call it. Long story short, it's just an indication of where prices are in the market relative to where earnings are. And right now that number is relatively high, especially relative to historical norms. And if we graph out where that price to earnings ratio has been relative to 10-year forward returns on the market, you don't have to be a really good statistician to be able to see that these dots kind of create a pattern, and it's an inverse pattern. The higher the PE ratio, the lower the following 10 years returns on average have been. There's a lot of scatter among them. You can't make a really strong prediction on any specific number, but you can certainly get a trend there. And so that's one place that, when we're looking at numbers, and this is what statisticians do all the time. They're looking at two different pieces of data to see if looking at one might predict the next. And so one of the things that leads us, that we come to a conclusion on looking at this is that we should be a little bit muted perhaps on what our expectations as to what the S&P 500 can deliver over the course of the next 5 or 10 years. However, importantly, that's only part of the type of, part of the market where we put our money. And so if we see, less opportunity in one place, we can always deploy it somewhere else. But in general, this is what we're looking at. This is where we've been when we see where treasury yields are and where the GDP has been growing. We've been in a pretty aggressively accelerating economy. So GDP growth has been high. And by and large, the Fed hasn't really done much of anything with interest rates, and interest rates haven't really moved all that very much naturally on the 10-year Treasury. But now we're getting into a situation where we think that those two things are changing. Those dynamics are changing a bit. Clearly, 10-year Treasury yields, we think, are probably going to be in a situation where they'll most likely be rising for the foreseeable future. And that GDP growth probably still growing. We're not going into a recession anytime soon from everything that we can see, but that growth rate probably decelerating. So still probability of getting decent returns from capital markets, but maybe not quite as outsized returns as what we've seen recently.
Thanks, Jim. Yeah, definitely good point that GDP growth starts out really quick in a recovery, early stage recovery, and then seems like we're getting almost to a mid stage already where it's decelerating but still growing. Right. Predictions are we're going to stay above trend line growth for the next few years, maybe 3 or 4 years. So that's still very positive. It's only when growth actually starts going negative that you get into recession talks and much scarier stock market returns. So we're in this middle ground right now. Finally, on the final slide here, we are coming to you towards the end of January. So I'm sure everybody's aware that the stock market's been having a bit of a rout so far this month, bouncing back nicely today, and we'll see what happens after the Fed meets this afternoon. But you probably heard a lot about corrections. Definition of a correction is a 10% drop off the all-time highs of an index, where a bear market would be a 20% drop or more. This chart shows the times the S&P since looks like 1950 has come down off its highs. There's been quite a few of them right now. That 7.69% we're down doesn't seem so aggressive as it probably seems, looking at your account balances, because we haven't seen a drop like that since the coronavirus, and it's actually abnormal that we've gone this long without a 10% correction. Typically they happen every 1 or 2 years. So Not an uncommon thing, actually a pretty healthy thing for the markets. Bring some of those valuations back down to more reasonable average levels, and kind of reset a baseline as we move forward.
And looking at it this way, 2020 looks just like kind of a little garden variety correction, doesn't it?
Just a little blip on the radar. Wish it felt that way.
Yeah, so true.
Great. Well, thanks for joining us. We'll see you next quarter.
See you next quarter, everybody.
The foregoing content reflects the opinions of Penobscot Financial Advisors and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be construed as investment advice or a recommendation regarding the purchase or sale of any security. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct.